Many people think that the geopolitical change is now driving Chinese investment. I would say that if you look back over the last several decades, it's Chinese investment and trade and its growing economic footprint in the world that has been the key change in geopolitics. Let me explain. China has not risen first and foremost as a military power. It has risen according to a pattern that's very similar to empires of the past, which is in fact focusing on supply chains. Now, especially since the 1970s, the two biggest changes in geopolitics have actually been the consolidation of the European Union into a common market with a single currency and the rise of China in global trade. And taken together, these have brought the world into a tripolar landscape: United States, European Union, and China. And it's largely been, as is generally the case in history, because of these economic shifts. So actually, it's the rise of China's outbound capital now reaching on par with the European Union and the United States that has been bringing about these geopolitical changes. As some people may know, China today is the largest net creditor in the world. It has surpassed Japan and Germany. So this is how geopolitical dynamics shift over time. Countries such as China have built up their indigenous industries, they've built up trade surpluses, the supply chains have come in, the currency reserves have been built up. China has invested in the modernization of its infrastructure and diversification of its economy, and now it is expanding its influence internationally. So now that Belt and Road is one example of China's global position and reach in the world, what does the data tell us about its focus geographically? Well, from 2013 to 2018, it's Europe that cumulatively has been the largest recipient of Chinese investment, totaling roughly $300 billion together. And this recent period has witnessed big shifts from previous trends, taking now just the last couple of years. For example, Chinese net investment into the United States has fallen from the previous high of roughly $100+ billion per year to nearly zero at the moment. But Chinese year-on-year investment into the Middle East and North Africa, the West Asian region, has climbed significantly, such that its 5-year total is very similar to the total amount of investment that China has made in the United States. So what you see is this significant diversification of the Chinese investment footprint, but also within that, a rising focus on the immediate Asian region. I do think, though, in general, I favor this Asia first strategy. Remember that Asia represents 4.5 billion people, all of China's neighbors, the majority of the world population, and there are still many complementarities between the Chinese economy and others in the region that have yet to be fully harnessed. So now let's talk about which economies in particular are benefiting from the rise of China as an outbound investor and creditor. The main beneficiary thus far has been ASEAN, the Southeast Asian countries. Now, to understand the China-Southeast Asia relationship in just recent history, we should begin with the Asian financial crisis of 1998, after which trade between the two regions has been steadily increasing. Let's remember that China offered the early harvest programs in 1998 to help Southeast Asian economies recover from the crisis. Now, in the last several years, we've also had the tensions in trade with the United States, such that trade between the United States and China has been declining, but China's trade with its major Asian partners, specifically ASEAN, has been growing quite significantly. So as of last year, China does trade more with ASEAN than it does with the United States. Now, at the same time, there have been other variables that have been introduced, such as the Trans-Pacific Partnership. Now, because many Southeast Asian countries have joined the TPP, as it's known, China has been able to use this region not only for its own stronger bilateral trade, but also to accelerate its export through those countries, through the process of relabeling goods and even offshoring manufacturing to Southeast Asia because of its lower wages. And lower wages is one reason why I see this process continuing, again, of the South and Southeast Asian relationship becoming closer from an economic standpoint. But now we can also talk about some of the regions that we have to be more careful about in the longer term, such as, for example, Africa and Latin America. China's investments in Africa and South America, for example, have been quite substantial. All South American countries actually trade more with China than they do with the United States. This has been actually very crucial for the resilience of agricultural supply chains. If we think about what's happened with soybeans, for example, and the diminished export of soybeans from the United States to China, but instead Brazil and Argentina picking up that slack. Now, the trade war, however, could also encourage, as the coronavirus has also done, to encourage more regional production and self-sufficiency. Now, I think in the long run, it favors China to, again, focus on producing or optimizing and harnessing the resources of the region, rather than these very distant geographies that are much more difficult to steer politically, given the turbulence and the decline in commodities prices, the instability that may result from the coronavirus, and the cutoff of supply chains that have also been the result of the coronavirus. Naturally, it should be expected that Belt and Road will receive more and more scrutiny the larger it becomes. The Belt and Road might be the fastest growing club in diplomatic history. Similarly, the Asian Infrastructure Investment Bank is a very fast-growing multilateral. But despite all the attention, it's also been misunderstood. The AIB, for example, does mostly co-financing. At the same time, what has been less than well understood is that most Chinese lending is still done through state banks, and that's going to continue to be the case. And this will receive more scrutiny as China's portfolio continues to expand and as it holds a growing share of the debt of recipient countries over time. What I do think is a very good move is the efforts to suspend debt payments on the poorest countries, given the coronavirus and the stress that it's causing in countries' fiscal policy and in their currencies. I certainly believe that the overall Eurasian infrastructure investment process and Belt and Road's role in it will drive greater corporate investment as well. That is the combination that we like to see happen. Private investment following public investment, whether that public investment is domestic and fiscal or whether it is supported by multilaterals. This has worked for many countries historically, and I do believe that this is a very tangible, measurable way to think about the progress that we can make with Belt and Road. Especially in Central Asia and to some degree in Southeast Asia, I see that this lending has been absolutely critical to modernizing infrastructure, to creating jobs, to boosting skills, to increasing trade. Generally speaking, we're seeing a correlation that over 5 to 6 years, strong fiscal support for infrastructure can lead to up to a 40% growth in consumption and a steady increase of at least 20 to 25% per year growth in inward foreign investment. So this is the virtuous cycle, the virtuous circle that we can see. Central Asia probably stands out as the region right now, such as countries like Kazakhstan and Uzbekistan, where we're seeing this cycle play out in the most positive way. I would like to see other countries follow that model as well. Belt and Road has been evolving and undergoing a number of shifts in the last couple of years that predate the coronavirus, such as more local inclusion, more sustainable debt, and a shift in priorities of project allocation within those countries. So now with the coronavirus, we see that there's a huge new emphasis on healthcare, on digitization, on the security of agricultural supply chains. I do not view these priorities as being substituting of BRI priorities, because of course these are national existential requirements really that countries should invest in. And I think that when it comes to healthcare, what we will see is that if countries do borrow more, If they build better healthcare facilities, they'll be importing more medical equipment from China, from Asian producers. They're going to have healthier populations, and that's going to lead to more productivity as well. So this rebalancing or shift as a result of the coronavirus is probably a positive thing in terms of the long-term social and economic resilience of these countries. So greater investments in digitization, you can imagine, benefit Chinese telecom equipment suppliers, in hospital construction and medical devices. All of these are, truly fundamental priorities. And Belt and Road is very much, or can very much be, about some of these softer areas as about hard infrastructure as well. So hence, I think that having the digital Silk Road, which has been in the making for several years, and now also a health Silk Road, are good examples of the diversification of the various verticals and themes within the Belt and Road Initiative. I believe that Chinese outbound investors should probably get used to a world in which there is going to be a systemic level and ongoing level of investment screening, especially in critical areas that relate to industry, that relate to technology, and so forth. And that the demands that the United States and the European Union have for reciprocity, market access, are also going to be sustained. Looking at the situation from their point of view, given the concern about trade deficits, job creation, and so forth, these are going to be long-term pressures. I do think, however, that from the Chinese point of view, there is an opportunity. As we see China dip into a current account deficit, as we see China trying to open up its debt, equity, and other capital markets to foreign investment, this is a critical time to find the compromises where, in exchange for unlocking, allowing more Western capital into the Chinese market, China can then, through the private sector and through joint ventures, be bringing in the kind of capital infusions that Western companies and Western markets also need. So this would be a very, very good time for Chinese players in this marketplace and Chinese regulators to be considering these kinds of compromises. Ultimately, what we'll see is that given China's rising debt as well, given the number of companies that it wants to raise capital for, the number of companies that it wants to see listed both in Asia and on Western markets, it would really be win-win to consider, opening up more rapidly, allowing in more foreign capital, and then in exchange, ensuring that there is a mutuality to the way in which Chinese capital is accepted abroad, because it is necessary both for Western economies as well now as for the Chinese economy. The process right now of diplomatic confrontation and the rhetoric that we hear from many countries could certainly be scaled back over time as the world heals and recovers. However, suspicions are going to remain even if this kind of rhetoric is no longer making headline news. I think that what's, again, very important is that at the level not of just statements and press releases, but the level of tangible cooperation, that we get back to an operational mode where China, the EU, and the US are constantly collaborating on a wide range of issues and not allowing their relations to be hijacked by any one issue. Some of those single issues are things like the coronavirus, or countries that are heavily indebted at the moment, or things like North Korea, for example. There are these single issues that have tended to hijack relations. But the truth is that we are in a structurally multipolar order for a very long time. The United States is not going away. The European Union is not going away. China is not going away. So what we have to appreciate is that even these tactical amounts of suffering that countries are facing as a result of mistakes, as a result of bad policy, they do wind up harming the three major powers in the system, given the volume of trade between them, given the volume of capital flows, given the need for transfer of technology, and given the fact that in a very volatile world, actually, we will only find the necessary long-term resources to tackle global problems like climate change or weak states and so forth through a coordinated instruments and approaches between these three major centers of power in the world.